Welcome to another episode of the All Tens Podcast. I'm your co-host, Josh West. With me, as always, Clay Harris. And today, Clay, we're being joined by a very special guest. She's a co-founder and CPA at Oak Ledger, a virtual bookkeeping and tax advisory services firm that helps clients nationwide reconcile their books and manage tax deadlines to help business owners understand their numbers and make better decisions. Please welcome to the pod, Rachel Sutton. Thanks for joining us.
Absolutely happy to be here.
All right. Rachel's my North Carolina neighbor, so I'm happy to be joined by from the town next door of beautiful Pittsburgh. Actually, callback to a previous episode, Rebecca from the Chatham Chamber of Commerce, also from Pittsburgh. Anyway, cool. Rachel, we're so happy that you're here. Before we kind of jump in to the wild world of accounting,
yes,
I want to ask like a little bit. You took an entrepreneurial leap at some point to start Oak Ledger. But, like, tell me about your career before you did that. Like, how did you make that decision? How did you get from wherever you started to here?
Well, you clearly have never worked in a CPA firm because it is very easy to leave or very easy to want to leave. It really was. I worked at a few. The hours are tough, man. And that's really what it boiled down to. When you're in tax season and the grind ranges between 50 to 70 hours a week for, 3 to 4 months. And then I always worked very closely with small businesses throughout the year on the accounting piece of it as well. So, the tax folks, April 15th, they got to check out, they'd take their 2-week vacation and they'd come back like rested and recharged. And for me and like the team I worked with, it was time for us to get caught up on all the stuff that didn't get done during tax season. So, after 5 or 6 years of that, it was, just really easy to kind of make a transition and go, I'd like to be a little more in control of what this schedule looks like. And I have met some great business owners along the way and people that I worked with and have been able to, just really naturally get referrals and work with businesses and help them. So that was how it all started. And it's been 9 years ago now, I think.
Oh, cool. So like you're in it now. Yeah, that's awesome.
Yeah.
So what I'm hearing is that you avoid the pitfalls of tax season by like, you just tell people don't pay taxes. Don't worry about it. We got it.
Oh, of course. I don't, more and more though, I'm hearing from people, do we really have to do this? I'm not sure if we have to. And I'm like, yes, we still have to.
That's awesome. Well, cool. What we wanted to do today, Rachel, and we wanted an expert on the podcast to make sure that Josh and I don't tell people, because like I think the last few episodes we've recorded, we had to say at the beginning and end, like, we're not professionals. So like we brought in a professional. We've been talking a lot. Well, let me back up. Josh and I work with small business owners. And a part of that work, a foundational part of that work is them getting to understand their numbers. And it happens more often than not that when we ask people about their numbers, they kind of bring, like 40 pages of reports from QuickBooks, and it's normally just like the P&L or the income statement. And you ask them about questions, they kind of get mired down in the $200 a month that they spend on the internet. And like, it's just really hard. And when you ask them about cash flow or balance sheet stuff, it's like, they don't know what you're talking, it's really hard.
The balance sheet is written in Greek to almost all business owners. It is completely foreign and doesn't make any sense.
Good. So those people are most of the people who are listening to our podcast. And what I wanted us to do today, and as not super deep, this isn't, we're not taking people to college, but like kind of, can we just go a little bit deeper on why those are important, how they work together, and maybe you can share some experiences or whatever, but take us there. Like, take us into when you go work with a business and they're trying to understand the financial health. Why do you not just look at one? Why do you need to understand all three? Maybe just start there and we'll start asking questions as they come up.
Sure. I mean, the beauty that drew me to accounting was just what a beautiful system it was, that this interrelation between all of these reports and that it's got built-in checks and balances and you've got accounts that you reconcile to make sure that your P&L is correct. So I think it's really cool to talk about these three different reports and how they all function together. Obviously, I geek out a little, accounting. But like you said, the balance sheet is one of the toughest ones because I think that business owners understand the P&L a little more because it does flow somewhat to the cash, and they can look at the cash in their bank account and go, we're knocking it out of the park, or we're stressing every month about making payroll. So the P&L makes a little bit more sense. They can see, revenue correlating to money that's coming in and expenses to money that's going out. That said, there's a lot of flexibility with how you organize your profit and loss or your income statement. And I really think that there's some differences that can be made there. I think with my clients, when I talk to them, the most important thing is let's make this make sense to you. So let's not make a chart of accounts or a profit and loss that makes sense to me. I understand these accounts and how they work, but let's call them something that when I ask you where your software expenses are going, you can easily look at your profit and loss and you know exactly where that's going to sit. And the same thing with revenue streams. If it's really important in your business to understand where that revenue is coming from, then it's really important to put that on your profit and loss so you can see those different things and the impact that they have.
So yeah, I 100% agree that the experience that I have is like on that when the business owner walks in with like the 40-page report and like they're all the same font. Like they all look important, right? And so I don't actually know, because I've never set up QuickBooks, if there's like a default set of accounts that you like start throwing stuff into or whatever. But I that's a great piece of advice for our listeners. The P&L is supposed to serve the business. You aren't serving a P&L, right? Like,
it's not a rigid structure. It's not like you get, and chart of accounts, I guess I should probably explain that. The chart of accounts are all the accounts that are going to be on your profit and loss and your balance sheet. So it's all of the accounts that you use in your accounting system. But if you were to look at those on reports you'd be familiar with, it would be the accounts on your P&L and the balance sheet. So there's a kind of a standard chart of accounts that's really generic, that generally comes with QuickBooks or any accounting software. I think it works as a great baseline, but really every business is different. And so to try to put your square business in this round hole, you're just not necessarily going to get all of the good data or the good information to make it easily accessible. You can always go dig for stuff, but you really want it to be easy to see and very clear so that when you look at that P&L, you see all the important stuff to you and your business.
Right. And you said something earlier that I think is common, is that it's really easy, or one way to approach it is like to watch the cash track with the receipts or invoices, and then when you spend money, it goes out. I'm wondering though, for our listeners who might be there, what are some of the insights that you see, or you help people when you're helping a client like utilize a cash flow statement? What are the things that kind of they could look at? What are there kind of key things that when you're introduced to a new business and you see their cash flow statement, you look for these three things? Or like just trying to give people a place to start.
Sure. So I think the cash flow statement is one of the harder ones to understand, because it tracks where your cash goes, but you end up with a lot of kind of very accounting-like accounts, right? So if the change in your receivables is going to give you a positive or negative number. So sometimes those things can be hard to understand because you got to conceptualize, well, where were we last month? Where were we this month? And that difference is what's flowing here. I think the biggest piece is to understand those main categories on your cash flow statements, which is going to be, what's happening from your operating revenues, what's happening from your, financing perspective. So it's going to show where those big changes were. So it's really just showing changes more so than actual, transactions. Like a P&L will show a period of time and all of the totals of those transactions. The cash flow statement, it shows changes in time. So it shows the difference from one period to another.
Rachel, in the spirit of I loved how you approach the income statement of, well, let's make sure that it's written in a way so that it makes sense for you. And
Mm,
so for our listeners, then as they become more advanced, now we've talked about three different statements, but they may still be looking at them in a very siloed fashion. And so can you take us deeper and perhaps in like the simplest terms, if there's an easy way for people to understand what is the interplay between them? And when you start there and you say, hey, like we've got to understand how they work together, what is the basics of that and how you
sure.
help them understand?
So I start with the balance sheet. The balance sheet to me is one of the most important. And the balance sheet acts like a snapshot in time. So when you think of your P&L, you run it for a period of time, right? Like last year or, last month. The balance sheet is going to act just like a snapshot. So you get one day and it will be what the ending balances are on that day that you pull your balance sheet report. Reasons that it's really important is it's going to list all of your assets. It's going to list, the liabilities you have. It gives you big picture of what's going on in the company. And what's really useful in your balance sheet is to create some metrics. So you can use your balance sheet accounts to do a quick ratio or a turnover ratio. So using those amounts to get these ratios that are really good indicators of financial health. And they work really good as benchmarks or goals for a company to set to make sure that they're in a healthy position. We have a client that does track 5 or 6 key metrics, and they've decided it's really important to them to have cash reserves so that they can weather any storms. And by tracking these things over the last several years, they've been able to 3x their reserves. And they're in a very comfortable position that they know, if the economy changes or if their sales dry up, they don't have to worry about how they're going to pay for their employees or how they're going to pay their overhead. They have all of that. And they've been able to do that by tracking these metrics that are all coming from the balance sheet. It's all of the assets, the turnover, any liabilities that you have. So that's why I think that report is so important. And then it switches over to the P&L. And so the P&L is, as opposed to that snapshot in time of the balance sheet, it will show changes over a period of time. So you can run a P&L or an income statement for any type of period, last year, last month, custom dates, however you want to look at it. And it's going to show you all of the transactions that occurred over that period of time. And it is going to include anything that's going to be revenue or expense, whereas everything on your balance sheet is going to be assets, liabilities, or changes in your equity. You're just going to see that income and expense on your P&L. And basically, every transaction has to go to one of these two places. There's nowhere else for it to go. So every time you have a transaction, say, you write a check to a vendor to make a payment, well, one half of that transaction is going to come out of your bank account, which is a balance sheet account. And the other half is going to go to an expense account, which is on your P&L account. And so this is that beauty of the accounting system that I talked about. Everything has a place and they're all interrelated so that you can track those expenses and track that bank account at the same time. The cash flow statement, I don't use all that often with my clients. I think it becomes more and more important, as you're growing the company and dealing with more and more larger numbers and to make financing decisions and things like that. But the cash flow statement is going to track where the cash went, what's coming in and what's going out. And so you start with your beginning cash at the beginning of the period. And similar to that P&L, it's going to cover a period of time. So you start with your beginning cash and it's going to show you all of the changes that happened to that period to get you to that ending cash number. So it shows you really what's happening with your money and where it's going.
Josh and I were talking the other day, and it's interesting because we think of it, our brains operate differently. So he was thinking about a transaction, and then he thinks balance sheet and then cash flow statement. Am I getting that right?
I go it's income statement, cash flow, and then balance sheet for me in my head.
Oh, then maybe I was just not listening very well because I think that's where I go too. But
That's mine.
I think the beauty of that thing, and I was explaining this just the other day with a client, is like, all right, like you send an invoice and it's going to show up on the P&L, right? The revenue, assuming we're operating accrual, right? But accrual, but it shows up on the income statement, and so you're like, cool, we did some great work. We sent an invoice, right? And then it shows up. Okay, never mind. Then for me, I'm like, oh, it shows up in AR, right? Which is like a balance sheet number in my head, right? And so maybe I was remembering correctly. I think income statement, balance sheet, cash flow, where it's like it shows up, sits in AR, and then once it gets paid, it shows up in the cash flow statement. But I know it's a triangle, really. Like they all kind of work together. So like that invoice increases AR, so it's showing up in two places. Then once they pay the bill, it's going to show up on the balance sheet in your checking account, and the AR is going to go down. So they're balancing each other out. And so I'm joining you. I guess all I'm doing is joining you in your geekdom, Rachel, for loving how the whole thing works together. And when you're just looking at the one, what you're really doing, whether it's you're just looking at balance sheet or just looking at cash flow or just looking at the income statement, you're kind of just flying without all of the instruments available to you, right? And
Right.
so like, and the way that this came true for me most of the time was like assessing a company when I wanted to buy it, like when I was doing M&A, because they might have a great P&L, but they're like hemorrhaging cash because of the ways they've chosen to finance the business or those sorts of things. And so it's really kind of important as a business owner to at least understand the inner workings, intra workings of those statements, right?
Absolutely. Absolutely. And to circle back, particularly when you have heavy financing, it does make that cash flow statement even more important because you won't see those debt payments listed on your P&L because the only real expense there is the interest. If what portion of interest. So you can have a lot of cash going out every month, like you said, but you're not going to see that in your P&L. So it really doesn't give you that full picture without looking at everything holistically together.
Am I right in also saying like or big capital expense, like they're like if you're making huge investments over time, like those might not show up on the P&L either.
Right. Well, anything that sits on your balance sheet. So, the assets, liabilities, those are they're not going to hit your P&L by definition because they sit on your balance sheet.
Got to look at it. All right, cool. Josh, I want to bring us home on this. This has been really illuminating conversation, I hope, for our listeners. And
can I add one more note that's come up just as I talk through this?
Yes.
So case study of a client that I work with, who is on EOS. We had some discussions about tweaking her P&L and saying, we really want some more clarity here. And ultimately, she wanted to be able to give her leadership team more accountability by way of the P&L. So what we did was we looked through her accounts and we took some generic accounts that, kind of everybody just got to dump into, right? Your employee appreciation and their capital equipment or non-capital equipment. So, new computers, headsets, and there were a list of things, each probably about 6 different accounts. And what we did was we split those up on the P&L so that it was very clear, well, this is your sales department and this is what they're spending in each of these accounts. And then we had the events department and we had, the back end office so that it was very clear from that P&L who was spending what. And they had that accountability to themselves and each other of that individual spending as opposed to everybody kind of putting it into one category and nobody really claiming it. And it really did have a huge impact and it let her team have that accountability and be able to see it. And in their meetings and in their review, they really got to own it. So I think that goes back to make your financial statements your own, right? Don't feel like you need to be rigid. use these reports to empower you to make better decisions and help your team really understand what's going on with your numbers.
There you go. Put that on a t-shirt. That's a great nugget for our listeners. Love it. Josh, any other nuggets before we wrap up here today?
She took it right from me. The big takeaway that I had was make it work for you. There's a lot of times where, 2 to 3 words mean the same thing to an accountant. And so pick the one that's going to make sense for you. So when you're lining things up on there, she gave a great example of, an expense. And so name it what that is so that if you get asked about it from Rachel or someone else in the organization, it's so easy to go and find. I think that organizing things in a way that makes sense for you, whether it's we're talking and ordering things from the most liquid to the least liquid. And if that makes sense for you to be able to see it in that order on the sheet or what you'd like to call it, and make sure that you have that common language amongst you and your leadership team so that when we're talking about these things, we're always talking about the same thing and it's easy for us to find, I think is well heard amongst everyone. Take them home, Clay.
Love it. That was a chicken strip, not a chicken nugget, but we'll take it. Thank you so much, Rachel, for joining us. I hope that everyone enjoyed this podcast as much as I did. If people want to get in touch with you, Rachel, or learn more about Oak Ledger, how should they do that?
Sure. Our website's oakledger.com. Keeps it pretty easy. There's lots of ways to contact us there. So take a look.
Awesome. If you want to speak with Rachel, please visit oakledger.com. Otherwise, listen to our next episode where we'll probably keep talking about important things. But in the meantime, I'm Clay. He's Josh. We're so happy that Rachel was here for us today. Listen, subscribe, rate, comment, share. Other things that you do with a podcast these days, we'd love to hear from you. So thanks again, Rachel, Josh, good job. Talk to you next time. Bye.
Bye, everyone.
Thank you.